Hey everyone, Justin Conroy, Financial Dad here, and welcome to another Financial Dad Quick Tip, where I give you a quick tip related to personal finance, wealth building, or money management in under 3 minutes. And today I want to talk about expense ratios on your investments. So first of all, what is an expense ratio? Well, an expense ratio is just an annual fee that all funds or exchange traded funds are charging their shareholders. So whether you know it or not, if you own index funds or mutual funds or ETFs or stocks or bonds or anything like that, you're being charged an annual fee. So my quick tip for you today is know that they exist, know how to find out how much they are, and pay attention to them because they can add up really, really fast. Let me show you. So to figure out how much expense ratios you're paying, I like to use Morningstar. You go to morningstar.com and go to the upper top left corner and you can type in your ticker symbol. I'm going to use HEMZX because it has a pretty high exchange rate and it's good for the example. So you pull that up in the search bar and it'll pull up this page and you can see it right there. Expense ratio 1.57 for this one. So what does that expense ratio look like in the long run? Well, I built this spreadsheet to show us. Let's take our average American making $50,000 per year, invest 6% of our gross annual salary into that investment, and divide that by 12 so that we get our monthly contribution amount. And you can sort of see what's already happening on the screen. I'll talk through it in a second. Expense ratio 1.57 we saw in Morningstar. Annual yearly growth of the stock market 10% if you ignore inflation and dividends, and we get our simulation. Keep in mind, I didn't mention it earlier, but daily expenses. Expense ratios are reported annually, but they are taken daily based on the value of your assets. So that's what's actually happening here. And this goes on for 40 years. Let's say you're doing this from the age of 20 to 60. Results. We put in about 120,000. They took about 164,000. Total growth was about $1 million, and at the end of the day, after all the expenses, we're left with about $1 million. That's about 16% of the total value of our assets. That's huge. So this is why it's so important to shop around. Take, for example, our HEMZX ticker symbol. If you instead go for the Vanguard fund that's relatively similar, definitely not the same, but pretty close, VEMAX, their expense ratio is about 0.14. So the total funds that they're going to take from us are not 160,000, they're about 20,000. A much better deal overall. You can also see how this simple change affected the growth so much. We were at $1 million in our final value. Now we're at 1.5 million. So it's not just the expense ratio that you're suffering from. You're also suffering from the growth that's being taken away when that money isn't in your account. If you want more information on retirement planning topics like this, be sure and click on the playlist on the screen right there. Lots of good videos, lots of good topics. Thanks for watching, everybody. Like and subscribe down below. Have a good one, guys.